Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Your next promotion is not just a step up in your career, it's a step closer to your dreams, your respect, and your financial growth. The Bank Promotion Exams 2025-2026 are your golden opportunity, and I'm here to make sure you grab it with both hands. In this journey, we will learn smart strategies, master important topics, and tackle questions just like the exam demands. Remember, success doesn't come to those who wait, it comes to those who prepare. So let's start today, prepare smartly, and make your promotion in 2025-2026 a reality. Welcome to part 19 of my Part to the Corner Office 2025-2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about case studies and group discussions to help you climb the career ladder faster. The subject for today is case studies about Outlook and lending norms for NBFC and NBFC MFIs. The previous case study videos links are available in description. The first case study is the high growth NBFC scenario. A well known NBFC, FinGrow Capital, with an A plus external credit rating, has applied for a significant credit limit enhancement. Its assets under management AUM have grown by 40% in the last year, far exceeding the industry projection of 15 to 17%. However, this growth is primarily driven by unsecured personal loans, which now constitute 85% of its portfolio. The proposal comes before the HLCC 1 for sanction. Questions. According to the policy, what are the key risks associated with FinGrow Capital's loan portfolio? What specific declarations and data should the processing branch obtain from the NBFC before the proposal can be sanctioned? If the bank's proposed exposure will be 18% of FinGrow's AUM, how should this be treated as per the policy? The solution is 1. The key risks are high concentration risk, 85% in unsecured loans against the benchmark of largest product that is less than 90% of AUM, and potentially higher asset quality risk due to the aggressive growth in unsecured lending or segment facing regulatory headwinds. 2. The branch must obtain A. A declaration on adherence to the large exposure framework, B. A declaration on the number of instances of liquidity risk breach of prudential limits in the last year, C. Data on its liquidity coverage ratio (LCR) and ALM returns to assess liquidity position, D. Confirmation of a robust cybersecurity policy. Third, as per policy, an exposure exceeding 15% of AUM is not automatically a deviation. The sanctioning authority HLCC1 can approve it. However, the proposal must clearly bring out the merits of the case, such as the company's strong financials, A plus rating, parent support, and good conduct with the bank to justify the higher exposure. The next case study is the New Age NBFC account aggregator scenario. DataStream AA, a newly registered NBFC account aggregator, NBFC AA, has been in operation for 2 years. It has an A rating and an innovative business model. It seeks a working capital loan from your branch. Its net own fund NOF is rupees 15 crores. Questions. Is this NBFC AA eligible for a loan based on its track record? What is the minimum NOF requirement for availing credit from your bank for this entity? Which specific risk highlighted in the policy is paramount for this borrower? The solution is no. As per policy, an NBFC should have been in operation for at least 3 years. This is an eligibility norm. However, the sanctioning authority to grant relaxations for repeated groups, the proposal would need strong justification for an exception. The policy prescribes a minimum NOF of rupees 10 crores for availing credit facilities. DataStream AA meets this requirement. The paramount risk is cybersecurity and data privacy risk. As an account aggregator, handling sensitive customer financial data, a breach could lead to significant reputational and financial loss. The branch must obtain a declaration confirming a robust cybersecurity policy is in place. The next case study is the NBFC MFI with regional concentration scenario. Upliftment Microfinance, an NBFC MFI, has applied for a loan. It has a good track record of 4 years and a CRI SIL rating of MFR4. However, 85% of its AUM is concentrated in a single state and its gross NPA is 5.2%. Questions. Does the applicant meet the bank's benchmark for gross NPA for NBFC MFIs? What is the concern regarding its AUM concentration? What is the minimum acceptable entry level internal rating for this entity? Solution. No, the bank's benchmark for gross NPA for NBFC MFIs is 4.5% or below, is 5.2% is above the threshold. The policy's eligibility norm suggests that concentration of AUM in a single state should be less than 80%, and 85% concentration indicates high geographic risk, making it vulnerable to local economic or natural disasters. Then the minimum entry level internal rating is NBFC 4. Next case study is the upper layer NBFC scenario. You are reviewing the account of Shriram Finance, which is identified by the bank as an NBFC upper layer, NBFCUL. The bank's exposure is within limits. A routine check reveals that its Tier 1 capital is at 10.2%. Questions. What is the regulatory minimum and the bank's benchmark for Tier 1 capital for an NBFCUL? Based on the above, what is your observation on Shriram Finance's capital position? What is the specific requirement for branches dealing with NBFCULs? Solution. For upper layer NBFCs, the regulatory minimum for CE81 or key Tier 1 measure is 9% and the bank's benchmark is 10%. While the NBFC is above the regulatory minimum, that is 10.2% is greater than 9%, it is below the bank's most stringent benchmark of 10%. This is a point of concern and should be highlighted in the review note for monitoring. Branches must ensure that the NBFC ULs are complying with the enhanced regulatory requirements prescribed by the RBI. The next case study is request for relaxation of norms scenario. A proposal for a new NBFC borrower fast track loans is put up to HLCC 1. It has been in operation for only 2 years but is sponsored by a renowned industrial group with an AA rating. It misses the 3 year track record eligibility norm. Questions. Which authority can allow relaxation in the eligibility norms? What condition as per the policy would support and relaxation? What is the minimum sanctioning authority for all new NBFC accounts? Solution. The sanctioning authority, in this case HLCC 1, can allow relaxation in eligibility norms. Policy states that an exception can be considered if the entity is sponsored by an entity with a minimum ECR of AA or equivalent. This condition is met. The minimum sanctioning authority for all new accounts as well as review or enhancement is HLCC 1. The next case study is breach of liquidity limits scenario. During a quarterly review of Liquidity First Finance, you find that NBFC had two instances in the last year where its cumulative negative mismatch in the 1 to 7 days bucket exceeded the 10% limit prescribed by the RBI. Questions. How should this be treated as per the policy? What action must the branch take? What should the NBFC have done upon breaching this limit? Solution. This should be treated as a breach of terms and conditions. The branch must comment on these breach instances in the review proposal. A detailed analysis of the causes and the NBFC's corrective measures is required. As per the post disbursement convenience, the NBFC should have immediately reported this breach to the bank along with the mitigation measures taken. Next case study is end user funds monitoring scenario. A large term loan was disbursed to Infra Debt Fund IDF NBFC for lending to a road project. 6 months post disbursement, you are tasked with ensuring the end user funds. Questions. List three measures you would take to ensure end user funds as per the policy. What type of certificate is crucial for this monitoring? Solutions. The measures would include periodical scrutiny of the books of accounts of the NBFC, examination of all aspects of conduct of the account, obtainment of a CA certificate with regard to the deployment of the bank's fund for the approved purpose, onward lending to the road project, the chartered accountant CA certificate confirming the deployment of funds for the sanctioned purpose is crucial. The timeline for submission should be commensurate with the project disbursement schedule. The next case study is the unrated corporation connection scenario. Steady returns NBFC has an exposure of rupees 250 crores from the entire banking system. It was previously rated, but its rating has expired, making it an unrated. Questions. What risk weight will apply to the bank's exposure to the NBFC? What is the rationale behind this high risk weight? Solution. As per policy, claims on NBFCs with aggregate banking exposure of more than rupees 100 crores, which were rated but have become unrated, will attract a risk weight of 150%. The rationale is to penalize the lack of transparency and independent assessment that a credit rating provides. A high risk weight conservatively provides for the higher perceived risk and impacts the bank's capital adequacy. The next case study is the NBFC under PCA scenario. The RBI places struggling finance limit under the prompt corrective action PCA framework due to high NNPA. Questions: what immediate action must the business unit take? Can the bank consider an enhancement of limits for this borrower? Solution: the business unit must put up a review note to the sanctioning authority within 15 days of the RBI's notification. No enhancement shall be considered for NBFCs placed under PCA by the RBI. The next case study is the security and collateral scenario. A proposal for secure land NBFC suggests taking a primary security of hypothecation of loan receivables. The branch manager wants to know if any receivables are ineligible. Questions: what is the primary security for lending the NBFCs? Are there any restrictions on the quality of these receivables? Solution: the primary security is the hypothecation of loan receivables. Yes, the security proposed should be hypothecation of receivables from assets that are non-stage 3 as per ECL norms. This ensures that the bank is not securing its loan against the NBFC's own non-performing assets. The next case study is risk weight calculation scenario. The bank is considering an exposure to two NBFCs. NBFC A, rated A by CRISIL long term. NBFC B has a short term rating of A2 by ICRA. Questions: what is the risk weight for the exposure to NBFC A? What is the risk weight for the exposure to NBFC B? Solution: for a long term A rating, the risk weight is 50%. For a short term A2 rating, the risk weight is 50%. The next case study is the case of external credit rating downgrade scenario. The board in its meeting approved lowering the eligible external credit rating for borrowers from AA to A. However, they expressed concern about increased risk. Question: what guardrails did the management propose to mitigate the increased risk? What was the final decision on the minimum eligible rating by the Risk Management Committee (RCOM)? Solution: the guardrails proposed were sanctioning detailed delegation were restricted to HLCC 1 and above. Only reputed groups with sound financial and promoters with adequate network would be considered. The RCOM unanimously decided that the minimum ECR should be kept at A instead of the proposed A+. The next case study is the mismatch in the AUM calculation scenario. The board observed that using assets under management AUM for exposure limits is problematic as it includes securitized assets and is an audited figure. Questions: what was the board's directive regarding the exposure limit? How was the policy document consequently modified? Solution: the board directed that the exposure limit must be based on net assets or net advances instead of AUM. Consequently, the bank's exposure should generally be within 50% of net asset or net advances of an NBFC. Next case study is checklist compliance scenario. A junior officer is preparing a proposal for an NBFC and is unsure what to include in the checklist. Questions: list any three critical items for the general checklist. What must be done with the climate risk checklist? Solution: three critical items are valid certification of registration from RBI, confirmation of compliance with the large exposure framework via borrower declaration, analysis of the top 20 borrowers based on asset classification and rating. The climate risk checklist from the bank's climate risk policy must be made an integral part of the proposal in all eligible cases. Thank you very much for your patience. Please do like, share, and subscribe to this YouTube channel.